Hi, everyone.
Hi, Jane.
Welcome, everyone.
Yeah.
Oh, hello.
Greg, hello.
How are you?
Doing well, thank you. James, welcome.
Thank you very
Welcome.
much. First time indeed.
Yeah.
James is in Shanghai, so I think he's the only participant from Shanghai today.
Wow.
Hey, Greg, good to see you.
Good to see you.
Good to see you, Greg.
A pleasure.
Welcome, Kate. How are you?
I'm good. I'm trying to avoid the big like sunbeam that's trying to shine in my face at the moment.
That's okay, we don't mind.
It looks good. Hi, Kate. How are you? Thank you for being here.
Yeah, of course. This is the time of day where the sun just starts to move. I had to do a TV spot around this time of day for Bloomberg Asia. And
Yeah.
I was basically blind, couldn't see a thing.
Well, it looks good from our end.
Christine, do
So,
we have
Kate,
all the competing teams on?
You know, I'm actually just checking right now. I have a lot of kids to scroll through, but it looks like we have everyone here.
It's Kristen. I logged in on my daughter's iPad and I'm trying to change her name.
Yeah.
Maya help.
Hi,
So anyway,
Kristen.
hello. Give me a couple minutes here and I'm playing with settings and all that fun stuff. Joys of too many kids, remote school.
No worries. So, Kristen, I have you teamed up with Kevin Carter today to ask your questions to the students, and you guys are going to be asking one question each, and you're going to be doing team 3 and team 6 today.
Excellent.
And I'll call on you so that you know.
It's a good looking group that we have here today. I love it.
it is a great looking group. How are you, Steve?
I'm doing excellent. Thank you.
Awesome.
I'm doing well because it's like 4 o'clock in the afternoon. I have no idea what time it is for everybody else. But,
And James, it looks like we have all of our students here as well.
Oh, good. Should we get started then?
Whenever you're ready.
Okay, well, welcome everyone. It's 7 a.m. in Hong Kong and Shanghai, and it's 4 p.m. in California and 7 p.m. on the East Coast. And we welcome you all to the 2021 Young Investors Society Global Stock Pitch Competition. We've been waiting all year for this. It's been a challenging yet incredible year for Young Investors Society. Starting with the year with 450 schools. And now we are near 1,000 schools participating in Young Investors Society, 960 schools. It's just been an incredible year of growth and learning and financial literacy and budgeting and investing. And we are grateful for all of you being here. This is the Global Stock Pitch Finals. And so we have Kate Moore as our keynote speaker and are so grateful for her. We have an incredible panel of judges, which I'll introduce later. And we have our 6 winners of the regional competitions from all around the world. And I am so honored to kick it off. My name is James Fletcher. I'm the founder of Young Investor Society. I'm portfolio manager at APG Asset Management, the pension fund manager of the Netherlands, where I'm based in Hong Kong. And I would like to start it off by thanking our sponsors. We have been so generously supported this year. As all of you know, Young Investor Society is offered for free to both students and teachers in schools. It is a nonprofit organization where our mission is to extend the learnings of financial literacy and investing to as many students around the world as we can. We'd like to thank Citi and EMQQ for being our gold sponsors this year during the competition. Thank you for your generous donations, and Young Investor Society could not grow or support our programs without you. We'd also like to thank our silver sponsors, JP Morgan, Investor Business Daily, Stockpile, Investometrics, Nevers Palazzo, and Wealth Source. Thank you all for your sponsors this year. It is my pleasure. We're going to kick it off by hearing from Kate Moore. And Kate, at the beginning, she was talking about all of the times where she's on Bloomberg Asia and CNBC, and Kate is an esteemed speaker in our industry, and we are so lucky to hear from her this morning. She is the managing director at BlackRock on the global allocation investment team, where she's the head of thematic strategy. Her investment mandate includes identifying opportunities to exploit structural change. Sorry, just one second. Policy evolution and dislocations across global industries. She's a member of the Human Capital Committee at BlackRock, and as we all know, one of the largest asset management firms in the world. I have heard wonderful things about Kate. As a side, we have been, Kate was graciously offered to be our keynote speaker at the gala last year, which was canceled due to COVID. So we've excitedly been waiting over a year to hear from Kate, and she's graciously agreed to give the keynote speech this year. So without further ado, I hand the time over to Kate Moore.
Well, thanks so much for that nice introduction. I have to imagine that some of the talk I would give at this time last year would be pretty different than what I'm going to talk about today. But some of the message would be the same. All I have to say is congratulations, all of you, on your hard work, on surviving the pandemic and making it through an enormously difficult year. Maybe not in exactly the same shape or in the same pieces that we started the year, but well done. And extra congratulations to everyone for discovering investing so early in their lives. I wish I had. It was something I didn't really come onto until I was finished with grad school. So what I thought I would do is kind of tell you a little bit about my path into investing and talk a little bit about, that's my dog making a noise. This is our real life, dealing with dogs and their toys. And then talk a little bit about some of the advice that I would give you as you think about developing your investing career and also your business career and your lives, things that I wish I had been sort of given, that same advice or shared when I was younger and at your age. The first is, I mentioned to you that I didn't really start my investing career until after grad school. In undergrad, I went to University of Virginia. I studied something called political and social thought, which was this incredible interdisciplinary major that allowed me to take classes in politics and economics and sociology, and really kind of learn a lot about the world. And then I worked some time in consulting for a strategy firm, a spinoff of McKinsey, and learned how businesses work, getting really into the guts of a lot of different businesses, something that really helped to inform the way I think about investing actually for the rest of my career. But I went back to graduate school right after 9/11, which was a really important and foundational experience, I think, for many people. And I decided I wanted to be an academic. And I went to University of Chicago to study political theory. And I thought what I would do was, be some sort of nonprofit maven. I was going to learn how emerging markets developed capital. I was going to save the world. I was going to really sort of change my life. And I ended up getting recruited by the chief investment officer of Morgan Stanley, who was looking for someone who had a policy and political theory background and was looking at the world differently than actually people that were coming out of their business programs, coming out of their MBA. And I thought to myself, I don't really want to go back into finance. But as I met the team, I realized they were all looking at the world very differently than I imagined a traditional finance or investing team might. They were coming from perspectives with history and economics and sociology and policy. And there was this wonderful combination of the macro, the economics, and the micro, understanding individual companies. And that's where I really ended up falling in love with investing. And I can now say 20 something years later, it was the best luck I've ever had. So I was thinking a little bit about what I would want to share with all of you as, young investors and as people who are starting off, your higher education careers and then also your professional lives in some years. And I'm going to offer up 3 pieces of advice that I think have been really important to me that I've been given at various stages of my life. And things I want you to have in the back of your mind as you move through your schooling and as you build your skills, particularly as investors. And they are: first, learn how to think. Second, seek out viewpoints that are different than your own. And the third is never be afraid to fail. In fact, maybe set yourself up for failure sometimes. So first, learn how to think. I mean, I probably could talk to you about this for a really long time. This is something I'm super passionate about. And as I was just mentioning, when I started out in investing, I joined a team that was thinking about the world in a lot of different ways. And it really kind of informed the way that I approach looking at market opportunities. And one of the most common questions I get when I'm interviewed or when I'm talking to a young mentee or to some of the junior analysts and associates at BlackRock is like, Kate, what do you read? Everyone is kind of looking for some super special, book, a Bible, if you will, that will help to unlock the secret of investing, unlock the secret of business success, unlock the secret to understanding markets. And so then I answer the question, and they don't always love the answer. And I say, I read none of that. I don't read business management books. I don't read memoirs of famous investors. I don't read stories about how to pick a stock. Instead, actually, I read science fiction and fantasy. So that might make me a little bit of a nerd. But the reason why this is important is that science fiction and fantasy helps to really school me. It teaches me how to think. And I'll explain a little why. So when I was at University of Virginia, I took this class that was called Fantasy and Social Value. And a lot of people signed up for this class because they looked at the syllabus and it was a bunch of fiction books, and they thought this is going to be very easy, despite the fact that it was a graduate level class. But what this class did was take all of these great books in the science fiction and sort of fantasy genre and ask us to explore them from kind of more a sociology and political and policy background. What was the environment that these authors were writing the books in? Was it, in the middle of the civil rights movement? Was it in reaction to some technological development? How did we understand the world in which that author was writing and everything else? You say, Kate, what does this have to do with investing? It has everything to do with investing, because understanding the world in which we're operating from multiple different angles is critical to getting your investments right. Look, you don't have to read science fiction and fantasy like I am and be a little nerdy, but you do need to seek experience and resources that challenge the way you think. So as you think about your education, I implore you to take classes that are not just economics and business and finance, even if your passion and your heart is in investing. Take classes on history, on politics, on different cultures, on literature. Train your brain to understand the world through a variety of different lenses. And I guarantee you, it will help you become a better investor. It's because investing is the secret kind of sauce to investing is not about a formula or building the right algorithm or analyzing a company in the same kind of financial model. It's about understanding the intersection of politics and people and behavior, other investors and consumer behavior. And you really only understand how to think about all of that when you've trained your brain in a lot of different disciplines. At this time in your life, you need to think about this framework for thinking. And this is something that's so important. You will learn technical skills and you'll gain market knowledge on the job if you choose to be an investor full time. But in high school and in college, this is your chance to really build the base, to build the framework for how you think about the world. And the best investors I know come from very diverse backgrounds. And most of the senior investors I know actually were liberal arts majors in college. Okay, so that's me telling you that learning how to think and learning how to examine a problem from a lot of different angles is, my view, the key to being a great investor. But the second thing that I really need to hammer home is that you need to spend time with people and resources and sources that really challenge the way you think. You need to learn how to listen and learn from people who don't agree with you. So some of you may be familiar with this term, confirmation bias. This is the tendency to take any new information and kind of fit it into your existing belief system. This is so common in investing. Someone has a thesis around a stock or around a market or around a bond, and they only take in information that helps to support the view or the position that they already have on. And this is disastrous. Actually, a real life example that is worth pointing out is what happened in the course of the US election in 2020 and even in 2016. We've seen a lot of people from a variety of different backgrounds, just surround themselves with people who only look at politics and candidates in the same way that they do. They are seeking kind of confirmation on their pre-existing views. And then the opponents ask, how can that person support that specific view or that candidate? If we only listen to and watch and read and absorb media that confirms our views and opinions that we already have, we'll never really understand the problem or be able to come up with a solution. And that is super true in investing. I like to say there's always a seller for every buyer. There's not always a buyer for every seller. Some stuff stays on the market for a while, but there's always a seller for every buyer, and understanding the motivations of that seller are critical to becoming a really good investor. So seek out others, whether it's in an investment club or in your community, that don't share your views, and listen. Don't take it personally when someone disagrees. Ask questions, and instead of trying to prove your point or convince them of your perspective. This is a really, really critical part to being part of a great part of an investment team, is listening to everyone else's views, asking tough questions, and allowing that to inform your own. One of the great investors that has been sort of a mentor to me throughout the course of my career said to me, "Kate, you never want to be the last person to acknowledge your wrongs. In other words, raise your hand once your thesis has changed because you've taken in new information, and admit that that has changed. It will gain trust with the people that you invest with. It will gain trust with your teammates. And it's really just kind of an amazing experience from a personal development perspective." The last thing I wanted to sort of say to you was, get comfortable with failure. They say the best investors in this world are only 51% of the time. And that's true if all of your bets are equal. But you can get it right a much smaller percentage of the time, let's say 30% of the time, if your winning bets are bigger and your losing bets are smaller, if you're sizing them appropriately. But getting comfortable with failure more than half of the time when you're an investor, because investing is incredibly humbling, means that you have to have a long path to that comfort. It's valuable to get cut from a sports team, or to struggle in a class, or to lose money in an initial investment. Because in my view, success in life is about how you deal with your inevitable failures. Success in investing is, how do you reflect on the failures, the bad choices you've made? Lord knows I've made quite a few, and then grow from it. Get comfortable with not being right all of the time, making sure that as you think about putting money to work and investing, that you have parameters. If I lose this amount of money, I'll step out, or I'll re-examine my thesis and write them down. And the more that you do outside of your investing life, in sports and activities and competition and stretching yourselves in classes and finding, how you can be resilient and really realizing that you are able to pick yourself back up once you've gotten something wrong. I think that's an incredibly important skill for an investor. So I have lots of other sort of concluding thoughts I was going to share with you, but I just want to congratulate all of you guys again for finding what I think is the most interesting, exciting, and dynamic activity, investing. it's something I'm so fortunate that is the main part of my career. And I keep on reminding myself, although I've been in the business for a couple of decades at this point, that it's a marathon and not a sprint. And that every time, I get through one earnings season, or I get through a big macro event, or there's been a big policy decision, there's another one across the field, or another one over the next hill. Now, so the average life expectancy in the US is something like 80 years. I personally think I'm going to make it a little bit longer. Most of my grandparents lived to be well into their 90s, which means that all of you who are part of the competition are not even 20% through your lives. And so thinking about investing for the long term while still taking advantage of some near-term opportunities and the changes and the dynamic technology that's out there right now is going to be a really exciting part of your overall lives. I'm going to say something else quickly about the industry. So over the course of my career, the asset management industry has changed dramatically. When I first started off as an analyst, I was picking up research reports off of a fax machine. Most of you guys have probably not spent much time with fax machines. You've missed nothing. And delivering them to other analysts on my team based on the sectors that they covered. Today, we're able to take in so much information from, all of these sort of social media. I watch Twitter to what different analysts and company management teams are saying, what lots of different journalists are saying. I have a huge source of contacts across the entire analyst community that help to feed me different views. I talk to my peers. I look at data. We use a lot of third-party and alternative data to try and figure out our theses. And it can be a little bit overwhelming, but I would say start small and understand that this industry is going to continue to change, and your skill set will continue to change if you choose to have a career in it. So I'll stop there and just remind you that it's okay to fail, that you need to surround yourself with people who challenge the way you think, and make sure as you continue your education, you're thinking about breadth and not just depth in one specific sector. So that's it for me.
Thank you, Kate. Let's give Kate a round of applause. That was just incredible. We knew you were a great speaker, and that was did not disappoint. Thank you so much, Kate, for your time.
Of course, I'm so glad, and good luck to everyone.
I wish we had more time for questions and interactions, and I wish this was a gala where we could interact and meet, but unfortunately, we'll have to save that for another day. Thank you, Kate. Okay, participants, I know you're excited and nervous for your time to present, and it has come. So let me introduce our judges. We have an incredible group of judges today. We knew that this was going to be a very close and challenging competition, so we recruited an incredible group of judges. So I would like to introduce and thank for being here, Greg Schell, Managing Director at Bain Capital, Deepika Sharma, Chair of the Board of the CFA Society of New York, one of the main societies in the world, and Director at BlackRock, James Sun, Head of Asia at TradeWeb, Jeff Garcia, Partner at the Capital Group, Kristen Nair-Hill, Managing Director at Bank of America, Merrill Lynch, Kevin Carter, the CEO of EMQQ and the founder, and Lee Mackey, Board of Directors at Young Investor Society and Partner at Nevers, Palazzo, Packard, Wildermuth, and Winter. Thank you, judges, for being here. We are so honored for your time, and students, be ready for tough questions to come your way. So with that, I'll kick it over to Christine, who will manage the stock pitch competition.
Excellent. Thanks so much, James. Thanks for the introduction. I'm Christine Tobin, Chief Operating Officer for Young Investor Society. A lot of the students know me. I know all of you because we've been together for the regionals and you won your regional event. So congratulations on that. Just a couple of housekeeping things today. Wanted to make sure that all of our judges know that they're going to be asking a question to our teams today. We have 6 teams competing. I have Greg and Deepika. You guys will be asking 1 question each to team number 1 and team number 4. Jeff and James, you guys are going to be asking questions to team number 2 and team number 5. And then we also have Kristen and Kevin, who are teamed up to ask questions to team number 3 and 6 today. So here are our teams, and this is going to be the order in which you present today. So team number 1, we have Utej Manava and Shivam Suri from the Central Peel Secondary School in Canada. We have Tejas Iyer and Alex Bruce from East Grand Rapids High School in Michigan. Elizabeth Jang from the Youth CEO Academy in California. Jasper Lau from Renaissance College in Hong Kong. Ray Vasquez from YNA High School in Hawaii. And Kevin O from Great Neck High School in New York. So like I said, this is going to be your order today. And without further ado, we're going to go ahead and get started. Remember, teams, you have 10 minutes to present your presentation. I know all of you guys aren't going to go over time today, but if you do, you will get a 2-minute warning. After the 2-minute warning, you get a time's up. So make sure that I'm in your header on your Zoom so that you can see me. But I think most of you have got it nailed down pretty great to be under the 10 minutes. So I will of course give you a 30-second buffer, so no worries about that. Does anyone have any questions before we get started? Nope, sounds good. All right, after your presentation, you will get questions from 2 judges. You will answer those 2 questions and then we will move on to the next presentation. All right, you guys, good luck. We're going to go ahead and start with Utej and Shivam from Central Peel Secondary in Canada today.
Hello, judges. Can you guys see the screen?
Yes.
All right. Shivam, you ready?
I just want to confirm that.
Yeah, go ahead.
Okay, thank you. You've seen the historic runs of companies that end up on Reddit's Wall Street Bets or Elon Musk's Twitter. You've seen them rally day after day, but fall just as fast. Maybe you were tempted yourself, but didn't want to endure the record highs and especially not the record lows. Well, we found a company whose potential is only outmatched by its reliability. Hello, judges and fellow investors. My name is Shivam Suri.
And my name is Utej Manava.
And we are research analysts from Central Peel Secondary School, here today to pitch Salesforce.com, ticker symbol CRM. We recommend logging Salesforce, the software CRM company, which currently trades at $205.68 as of March 25th, because it's undervalued by a calculated 23.4%. The market has incorrectly overemphasized the tech sector's decline, and there's significantly more upside to the recent Slack acquisition than priced in. They've also beat out the S&P 500 over the last year, thus showing strong and investable growth. We also see increased growth over the pandemic and beyond, which has created exposure for the importance of online customer and business relations.
Now, what is Salesforce? Salesforce is the world's #1 customer relationship management or CRM platform. They produce cloud-based applications for managing sales, service, marketing, and much more. Some key LTM financials include $21.3 billion in revenues and $3.3 billion in EBITDA. This translates to LTM multiples of 46.7 PE and 8.9 PS. A breakdown of their most recent quarter, ended January 31st this year, they had total revenues of $5.82 billion, up 20% year over year, of which 94% was attributed to subscription and support, and another 6% to professional services. We believe there's an underestimated potential of the digital transformation spend. Analysts forecast a slight revenue decline this year, but the global digital transformation spend is expected to reach an inflection point. Now, before we move on with the presentation, let's take a closer look at one of Salesforce's best-selling software, Sales. The Sales Cloud is an all-in-one cloud-based application that allows sales teams to effectively manage their cycles, prioritize tasks, access smart insights, and deepen customer relationships. It includes tools for contact management, sales forecasting, and managing leads. It's a #1 fully customizable platform to grow digital sales.
The CRM industry is rapidly expanding as it's experiencing a large boost from the pandemic. At the helm of this growth is Salesforce, whose great financials and services have kept them at the top. CRMs have a very wide variety of applications that can be used to digitally transform any type of business, whether it deals with customers or internal controls. For companies using a mobile CRM, 65% are reaching their sales quotas, while only 22% of companies using non-mobile CRM have reached the same targets. The reach of mobile CRMs have also dramatically increased. The mobile CRM business will reach $15 billion worldwide by 2021. By 2025, this market is expected to reach $80 billion in revenue, representing a 10.3% CAGR. This increase is driven by the fact that 47% of businesses are planning to increase spending on help desk and customer service software, while 60.7% of businesses will be investing more into the digital marketer's wallet in 2021. That's an estimated $600 million.
For our first thesis, we're covering Salesforce's high switching costs and locked-in factor. First, the gateway. They have a compelling value proposition for typical IT enterprises. The most popular application, Sales, hooks clients by reducing physical assets and migrating data to the cloud. This addresses the most immediate pain point for customers. Next, they're given the cross-sell opportunity because they can then use data collection to deepen customer relationships, thus increasing switching costs. The company has effectively turned sales expertise into customer reliance on other products. In fact, single cloud customers increased their average number of subscriptions 2.1 times from 1.8 to 3.6 in the last 4 years. And at the end game, there isn't one because each cross-sell strengthens customer integration into the robust ecosystem. The platform stickiness increases with each reliable product. And this is proven by the company's highly consistent CAGR for TAM growth across all their cloud offerings in the Customer 360 suite. For the second thesis, we're covering the accretive acquisition strategy. Since 1999, Salesforce has employed an acquisition strategy to build a rounded suite of products. Key purchases such as Demandware and Quip have now become applications known as commerce and productivity, respectively. Their acquisitions allow them to service a large variety of customer needs. For example, the purchase of Tableau in 2019, straying from the cloud-focused mission to support businesses with legacy infrastructure. In addition to their CRM cloud applications, Salesforce now provides a holistic solution to access insights from all types of systems. And the Slack acquisition closing in the second quarter of this year is a rather recent purchase. Projections indicate a $4 billion revenue mark by fiscal year 2026, or a 38% four-year CAGR. This pushes total 2026 revenue targets to $40 billion, culminating to a 19% four-year CAGR across the entire suite. And this, as we can see, this move presents very high hopes following Slack's integration into the suite. Now for Salesforce's competitive positioning. For brand, Salesforce boasts a reputation for creating applications to help businesses grow, and innovation has kept the company at the forefront since 1999. They also benefit from customer stickiness because CRM can cross-sell customers subscribed to any application within their suite. Salesforce sees the advantage of an economy of scale. Being a dominant competitor allows them to increase their velocity of sales while reducing scaling and customer acquisition costs. Our Porter's 5 Forces analysis also indicates that Salesforce is way ahead of the competition because their one-stop shop operations keep customers using similar services from the same provider for reasons including security and low fees. And we've also located opportunities for Salesforce to grow their revenues. First, their product portfolio has rapidly expanding TAMs. They predict rapid adoption of their business products, most notably sales, with a predicted 11% four-year CAGR. And this culminates to a $175 billion TAM for the whole suite within 5 years. Next, their companies prefer adoption of the full suite of their products because multi-cloud subscriptions represent 93% of their annual recurring revenue in fiscal year 21 over last year. And this indicates a preference for the full ecosystem. Thus, the Customer 360 suite represents a strong value proposition. And lastly, their international expansion potential, because Salesforce is over-indexed to certain regions with 66% of their ARR from North America alone. They've also under-penetrated in Europe and hold a negligible share of APAC and Africa.
Salesforce is expected to see some major growth due to its direct catalyst. Some catalysts to suggest this growth is their upcoming merger with Slack, which will give them a larger asset portfolio as well as a larger customer base, their year-end earnings, which projects a 21% increase in 2021, and 3, the expansion of Sales Cloud 360, which is a way for businesses to use artificial intelligence to compare yearly data that may have been skewed from something such as, say, a global pandemic. Now let's delve deeper into the finances. Their gross profit margin is well above industry norm, holding at least 62.27% for the last 1.5 years. They also have enough cash on hand to sustain themselves for a full year, which is twice the recommended time, a mere 6 months. They've also steadily increased EPS 4.7 times since 2019 and have a 36% asset turnover. This asset turnover ratio, paired with their 28% quarterly growth in assets, suggests that future revenue is to come. We believe that the valuation of Salesforce will greatly increase over the next 12 months as per financial data accurate to March 25th, 2021. Our bear case sees an increase of 17.2%, our base case 23.4%, and our bull case sees an increase of 29.9%. These estimates were calculated based on a 5-year DCF EBITDA exit valuation method, as well as a 1-year EV over revenue multiple valuation method. These valuation methods require projected multiples to determine the share price. Thus, we use competitors, historical, and present multiples as the basis for our projections and calculations.
Now for some investment risks. First, the dilution of shareholders. Raising capital hurts shareholders in the short term, but long-term prospects are always strengthened. We give consideration to 60+ acquisitions that have proved successful for CRM in the last 20 years. A customer data breach. To avoid this, Salesforce invests in layered encryption, and customers are also much safer allocating their business processes to one software provider versus multiple distributors. And lastly, the entrance of new competitors. We believe Salesforce's high switching costs and their reputation will keep customers reliant on their products.
ESG values. Now, Salesforce has made some value and efforts to be clear and transparent with their ESG information. For environmental sustainability, they show full transparency in the fact that although their recent carbon emissions have increased year over year, the rate of growth is slowing and is much less than the industry average. They also strive for social equity for all. According to the company, they plan to have 50% of all workers be underrepresented groups. And lastly, they operate with integrity. Proof of this comes from the fact that they were named on Ethisphere's 2020 World's Most Ethical Company due to their internal policies, which describes the way that they treat employees and other key global stakeholders. They also have an extensive list of code of conduct rules that all who associate with Salesforce must agree and abide by. So as you can see, CRM has an excellent array of catalysts to help accelerate their business, excellent financials to help them gain market share, and a strong ESG system with deep care for their consumers. And for these reasons, as well as the ones mentioned, we believe Salesforce is a strong investment for the upcoming years. Thank you for your time, judges. We are open to any and all questions.
Great, thank you so much for that. Greg and Deepika, you guys are first up. So Greg, do you have a question for the team today?
Yeah, happy to. First of all, really well done and organized. Thank you for that. Let me see. I have found tech to be incredibly interesting over a long investment career, in part because it's one of the really few industries where most of the segments are dominated by one player. They're sort of winner take all kind of games, unlike consumer categories or consumer retail and so forth. That combined with the fact that a lot of investing requires you to take a point of view on the future, I have found tech to have such dynamism that it is really, really difficult to take a position on the long-term future. My question is twofold. One, what makes you take such a strong position on Salesforce's market positioning, given that others are trying to nip at their heels? Do you think that they have better tech, or is it that they're just so entrenched that users don't want to switch? I want to know a little bit more about the basis of your confidence, number one. And number two, I think you've talked about lots of reasons why you thought that this was a misunderstood and undervalued stock, yet your math tells you that it's a little bit more than a 20% opportunity for return. Tech clearly is capable of much more than that. If it's such a good idea, why is there not more upside? And is this the right and appropriate amount of risk to take for something like a 20% return?
Sure. Thank you for the questions. I'll take the first one about the competitive positioning. So one of the main reasons why they've been staying ahead of their competition, major competitors including Microsoft, Adobe, SAP, these are very big companies, and they're much bigger than Salesforce. But we believe Salesforce has been able to stay ahead for so many years because of their diversity in their product set, right? We mentioned in one of our theses actually where they might hook a customer with one of their most popular products such as sales or commerce or marketing. And once they bring them in, they can begin to integrate them into their ecosystem. And eventually they build customer reliance to the point that it's too expensive to switch out. And that's ultimately their locked-in factor that we believe keeps consumers in.
Yeah, and for the second part of the question, in terms of the risk reward, so we mentioned the fact that we believe 1 year of holding would be the best possible scenario. And after that, it's a little bit of personal caution. So Salesforce being a digital company with a product and software, things can obviously change very quickly, and pure numbers will not show their pure growth. Looking 5 years out for a company as market dominating as this one is possible, but the estimates can be greatly varied. You see that in the big tech players, like something like Tesla, which has either $3,000 price targets or $10 targets. So they can release new products or new services, which also won't require any manufacturing. This saves quite a bit of time. So for the research, for the retail investor, it is a little bit difficult to see how much they'll grow past a couple of years. But after the first initial year, we say that assuming the pandemic is still in effect, it will grow through this because people are at home. People need a good way to communicate with their customers as well as their internal controls. So for 1 year at least, we do see a large amount of growth. And after that, it's more of, if nothing else has changed in their business model, then our 5-year estimate is reliable.
Great. Deepika, did you have a question for the team?
Sure, yeah, I would echo Greg in saying this was a fantastic presentation. I think as you were going through it, I was coming up with questions and then you answered them in the next slide. So really good job. I guess my question and comments are more around, what you just mentioned about time horizon. So when you're thinking about investing, what your time horizon is really important. Are you looking at the next 3 months, the next 6 months, or the next year? And I think the story that you laid out here is a very good case for building a more secular trend in the sector that you're looking at, as well as Salesforce as a company and its positioning. But I'm a little bit skeptical still about the 1 year time horizon. Did you consider kind of the risks, the short-term risks that could occur, whether it's macro or micro or specific to the sector, or even I know you mentioned something specific to the company around the acquisition, but I'm looking for something kind of more broader. So did you consider kind of macro risks that could, lead you to change your outlook and convert from a buy to a sell rating within the year?
So one of the major risks coming up, at least, or we feel that obviously we talked about that the company is undervalued. And one of the main reasons for this is because of exposure. Now, during the pandemic, people have started looking at mobile CRMs and started implementing them into their business. But before the pandemic, it wasn't really looked at, and it was a very niche market. So what we believe is that now there are vaccines that are coming out and people are getting them. They're starting to open up into different phases. So we believe that if people start going back into work and if people start straying away from the stay-at-home mentality, then that could have a negative impact on Salesforce. Of course, there's a lot of other factors that come into play because we do believe that the exposure they've gone from the pandemic should be able to outlast this the vaccine rollout. However, if that's not the case, then that might be something to look out as people start going back into work.
Right. I'd also like to add one more thing about the time horizon and the holding period. So we've been seeing a lot of volatility in the last few months. Our price was actually March 25th, which is 2 months ago, and it's already May and it's already around $230. And it swung a lot. It went from $230 back to $200 and back up now. We're seeing a lot of this action, and we believe it's a lot surrounding earnings season. Every time earnings come out, even though they top expectations, there could always be some short-term action, and you always have to see past this and see in a year we see confidence from institutions, right? Since 2019, they've been holding 80% of the shares of CRM, which is much higher than previous years, and this company has been around since 1999. So that's a lot of confidence we've been seeing, and they've been holding that for the last 2 years. So yeah, although there is volatility, we do still see the uptrend, and we have confidence in it.
Tej and Shivam, thank you so much. You guys did a great job.
Thank you very much.
Thank you.
You're very welcome. Our next team that is up is Tejas and Alex from East Grand Rapids High School in Michigan.
All right, let me quickly share my screen here. All right, can you guys see the PowerPoint?
Yes.
Okay, 1 second. Let me minimize. All right, full screen?
Yes.
Okay. All right, Alex, ready?
All right. Hello, judges. My name is Alex Bruce, and my partner's name is Tejas Iyer. And today we are pitching American Tower as a buy to hold. As Warren Buffett said, boring is beautiful. Despite American Tower's supposed boringness, we will tell you how it can make a beautiful investment. American Tower's share price as of Monday afternoon was $253.05. Our 2023 target price is $382.63, which is a 51.2% upside from the current stock price.
American Tower is a leader in wireless and broadcast communications infrastructure and real estate, and a pioneer in edge computing. With more than 186,000 sites, 42,000 in the US and 142,000 internationally, American Tower is the largest tower listed in the US and a large international player. American Tower maintains a strong competitive position in the tower industry, as each tower leased acts as a micro market where American Tower has pricing power. In this industry, there is what is known as a first mover advantage, meaning that once land is occupied and the tower and communication infrastructure is set up, the land value increases, making it more difficult for new firms to enter the market. In other words, there are high barriers to entry. Additionally, economies of scale and multi-tenant sites drive profitability. Overall, American Tower, although a large player, has continued potential for revenue growth through pursuing opportunities such as international organic growth, 5G and edge computing, and site acquisitions.
As said before, American Tower is part of two main industries, tower leasing and edge computing. American Tower leases towers to wireless companies such as Verizon, T-Mobile, and AT&T. 95% of revenues come from property leasing, while an additional 5% come from servicing. AMT has an average 4 and 1.9 tenants operating on each tower domestically and internationally, respectively. As shown in the graph on the right, the more tenants per site, the higher return on investment for that tower due to economies of scale, which allows revenues to come at little to no marginal cost. Currently, American Tower also has 6 edge computing locations across 5 states and is looking to grow. To realize the full potential of advanced applications such as AI, 5G, cloud computing, network architecture must drive closer to where data is being optimized or consumed for optimization and efficiency, the goals of edge computing. Moreover, their turnkey infrastructure provides what they call an all-in-one edge solution, bolstering data processing. American Tower is poised favorably in both segments, positioning them for future growth on top of their past growth.
We believe that American Tower, based on its past and recent performance, its market dominance in a growing industry, and potential for long-lasting growth, is a buy to hold for a diversified, growth-based, and innovative portfolio. American Tower has attained a unique position as a dominant player in the tower industry, owing to its substantial competitive advantages and moats. Furthermore, American Tower's strong track record as a global leader in wireless communications infrastructure with its large global site holdings makes it sure that American Tower will continue to maintain this dominant position in the growing industry, especially as it expands with initiatives in 5G and edge computing. American Tower is also a worthwhile value investment. Its fortress balance sheet, investment-grade ratings, ESG initiatives, and cash firepower give strength as a growth-based investment, and its attractive high margins and EPS growth are sure to create strong returns. Finally, our 2023 target price of $382.63 indicates American Tower will remain a staple of a returns-based portfolio for a long time to come.
American Tower has a uniquely advantageous position in the tower industry. Within the US, American Tower leads its main competitor, Crown Castle, in sheer tower count, with 3,000 more towers. In addition, American Tower's rural and suburban growth focus contrasts with Crown Castle's urban focus. Internationally, American Tower's early expansion into India, Africa, and South America gives it a powerful moat. Therefore, we rate the threat of industry competitors as low due to economies of scale and pricing power for existing towers. We rate the bargaining power of customers as very low, as the multiplicity of wireless carriers allows American Tower to choose its tenants. Because of the long-term land leases and significant initial capex, especially in the US where the market is mature, we rate the threat of new entrants as very low. In addition, we rate the threat of substitute products as low because their limitations confine them in their ability to threaten American Tower's established business model. Finally, while there may be some competition for high-quality assets, American Tower's business model involves the purchase of a readily available commodity, land that is often otherwise useless. Therefore, we rate the bargaining power of suppliers as very low. Because of the exceptional competitive positioning that American Tower enjoys, AMT is surely an excellent buy for a stable portfolio.
AMT's revenue drivers fall into two main categories, organic growth drivers and strategic tower acquisitions. The first organic growth driver is mobile data growth. As data plan and smartphone prices fall, worldwide mobile data traffic is expected to grow immensely, an average of 28% across all regions. The second subset of organic growth is 5G and edge computing. American Tower has already capitalized on the unprecedented growth due to 5G, the recent 15-year, $17 billion contract with T-Mobile, as well as the 20,000 tower deal with Dish Wireless. American Tower also focuses on the acquisition of sites from tower companies with large international holdings. For example, in just the past 2 years, AMT added 5,700 towers to their African portfolio and 3,500 future towers to their Canadian portfolio. As of 2021, AMT is looking into a possible Telxius Towers deal, adding almost 31,000 existing towers and 3,300 committed build-to-suits across Latin America and Europe. Through its strong organic growth drivers and the acquisition of towers, AMT is expected to have 25.2% compounded annual growth in revenues for their tower leasing segment, and likewise 37.4% for their edge computing segment.
CEO in early 2020, Thomas Bartlett has driven impressive revenue growth. Even now, American Tower has begun to bounce back owing to a swift and effective response of keeping employees safe during the pandemic. Underpinning the recent increase in American Tower's stock price and market capitalization are Bartlett's three core strategies: his focus on expanding tower leasing into new markets, edge computing, and his culture of growth mindset. As a 25-year veteran of Verizon, Mr. Bartlett understands how customers think, bringing in 6.1% revenue growth in 2020. American Tower's board of directors includes 11 members and CEO. As Warren Buffett notes, everyone should have a boss, and the fact that the CEO is not on any board committees reflects this accountability. However, having the CEO on the board itself is powerful, as the CEO can pitch in during decision-making to achieve his long-term goals.
As with any reputable investment, there are some risks involved in the decision to invest in American Tower. American Tower is subject to risk inherent to any business operating on a lesser lessee model, such as tenant instability and intertenant agreements. As mentioned in our analysis of competitive positioning, there are up-and-coming technologies that have the potential to impact American Tower's bottom line. There are also risks to the company's growth stemming from acquisition costs. Finally, as with any investment, one needs to consider downside risk. Fortunately, a BBB+ rating from S&P, a Baa3 rating from Moody's, and a BBB+ rating from Fitch indicate that American Tower is an investment-grade corporation. In addition, American Tower's $6.7 billion in total liquidity gives it the firepower to not only maintain growth, but also acquire other businesses. While there may be some negligible risk to investment in American Tower, we believe that they are far outweighed by the benefits that it brings to a portfolio.
A company with a good ESG focus can mitigate risk for its shareholders. Regarding the environment, AMT has invested almost $100 million in green energy solutions, reduced diesel fuel consumption by 2 million liters a month, and started a tree planting initiative in 2019 to remove 200,000 metric tons of CO2 over the next 40 years. From a social standpoint, AMT places a large focus on the empowerment and education of employees and provides almost $3.5 million annually toward these ends. They have also started a digital village initiative to increase access to the internet and underserved populations internationally. Additionally, their management team has a stand and deliver mission to lead wireless connectivity around the globe, innovate for a mobile future, drive efficiency throughout the industry, and grow their assets and capabilities to meet customer needs. Plus, with a sub-industry average injury rate of 0.04 per 100 employees, American Tower is on Forbes' best mid-size employers list.
American Tower has seen exceptional revenue growth at 6.5% compounded annually over 3 years, fueled by both domestic and international organic growth, especially in Africa and South America due to refreshes in 5G infrastructure and expansion in the novel edge computing industry. However, what makes AMT special is that this growth is not accrued at a loss. Warren Buffett says that if you've got the power to raise prices without losing business to a competitor, you got a very good business. AMT reflects this assessment, given it has sustained gross margins of over 70% for the past 3 years, showing that AMT is growing without losing pricing power. AMT has also shown overall profitability with 3-year averages of 33.3% operating margins, 23% net income margins, and 36.7% free cash margins. As a cherry on top, AMT has also shown a 3-year average EPS growth of 23.3%, which will contribute toward our valuation.
As highlighted in their fiscal year 2020 earnings call, American Tower was not majorly impacted by COVID-19. For example, it saw 7.6% growth in adjusted funds from operations, 6.5% growth in property revenues. They also expect 8% growth in property revenues for 2021. However, AMT's current stock price is not reflective of their growth in revenues and operations, in part due to general market uncertainty. This is a great opportunity to buy and hold American Tower stock.
Our 2023 target price for American Tower is $382.63, a 51.2% upside from the May 24, 2021 closing price of $253.05. To arrive at this value, we calculated low, average, and high scenarios for diluted EPS growth. With an estimated EPS of $6.04 and our multiple of 63.35, we arrived at our target price. In addition, we use a discounted cash flow model with a future terminal growth rate of 8.5%, given a market implied growth rate of 7.95%, representing past growth. As shown on the right, after calculations, we arrived at an equity value per share of $352.82, representing a 39.4% upside. We chose to use a relative valuation method for our final valuation, as a relative valuation technique produces a result more accurate in the short term. In light of innovation, rising revenues, continued pricing power, and wide moats, we believe that American Tower is currently undervalued and that its intrinsic value is much higher. AMT's further growth will help the stock price accrete towards its intrinsic value, bringing long-term and stable gains to a growth-based and innovative portfolio. Thank you, and we are now ready for any and all questions.
Thank you. That was great. Great job, you guys. I'm going to go to James and Jeff. You both get one question each. If you wanted to start, James.
Absolutely. Good job, guys. And I particularly like the fact that you discussed the senior management, the CEO, and the strengths of the management team is always a key element that we look at while evaluating a company, especially for the longer term development. My question is more on a request for you to elaborate a little more on the risks side. Technology developed very fast, and we certainly have the potential disruptors, so to speak, both in terms of new technology and also new players that came out of the evolution of a new technology. Please elaborate a little bit on that, and not only from the perspective, not only for the company itself, but it's also for its key clients and customers.
So one of the biggest technological developments recently in this cellular industry is the advent of widespread satellite cell service. I'm sure you all have heard of Starlink, Elon Musk's Starlink, and there's various other projects out there. However, what is deficient in these programs is that they're not currently as effective and likely cannot be as effective as traditional cell towers or ground-based cell towers. This is just due to limitations in our current technology and limitations even in what is theoretically possible in technology. So therefore, Starlink and these other programs deliver very low quality reception, especially in urban areas, and they're more difficult to implement new generations of technology like 5G. And yeah, their overall, generally their use cases are much more limited than American Tower's use cases too.
Moreover, from a risk perspective, most of American Tower's deals and deals with cellular companies such as Verizon, T-Mobile, and AT&T, as we mentioned, are on average 20-year deals. So this is not really a short-term risk for American Tower, and they have time to find new ways or continue doing what they're doing to continue growing and acquiring, and also funding organic growth with edge computing and distributed antenna systems.
Thank you. Jeff, did you have a question for the team?
Yes, great presentation. I really enjoyed learning about this, and I think the companies you picked are a big part of the project. So great job in highlighting a company that's probably underspoken about. I had a question a little bit on the financials, just on expectations. You guys did a great job of highlighting the margins, and it looks like from reading through the notes in your report, there's a lot of good revenue drivers, but there's also some margin expansion, I think, embedded in the earnings growth you guys are looking at. So the question is, what are the elements of the business that give you confidence, the business or the management team that give you confidence that, that margin expansion can continue and be a part of the robust growth you guys have?
So one of the biggest things that we believe is contributing to American Tower's growth perspectives is the 5G boom and the amount of increase in data traffic. For example, in the US, there's 32% compounded annual growth in data traffic, Germany's 27%, France 34%, and Brazil 32%. So just the sheer percentage of growth of mobile data traffic, we believe will contribute to American Tower's growth. And also with 5G, this brings the advent of new 5G deals, such as the one we mentioned with T-Mobile, where there's a 15-year, $17 billion contract, which will contribute also to American Tower's growth.
Excellent. Great job, guys.
Thank you.
Thank you.
Thanks.
All right, next up we have Elizabeth Jang from the Youth CEO Academy in California.
Okay, can you all see this?
Yes.
Okay. Good evening, everyone, and good morning to that one person in Shanghai. My name is Elizabeth, and this is my stock pitch on PayPal. So a little bit about PayPal before we begin. It was founded in 1998 as Confinity, acquired in eBay in 2002 before becoming its own company in 2015. So PayPal basically offers a digital alternative to traditional payment methods and allows customers to shop safely by eliminating the need to offer their credit card information. It currently has over 361 million account holders worldwide. So chances are if you don't use PayPal, you probably know someone that does. And some of its major subsidiaries are included below. So for my investment thesis, I would rate PayPal a strong buy for the following reasons. It has a steady position, it's able to use its strategic acquisitions and partnerships to expand its network, and it's in support of crypto, which reflects their vision of a cashless future. So to understand PayPal, we need to first understand the industry that it operates in, which is the financial services industry, and it's best explained by the payments ecosystem as shown on the screen. So long story short, the acquirers and the issuers are the banks, payment networks oversee all fiscal transactions, gateways are like the middlemen between the customers and the banks, and the ISOs are the middlemen between all of the above. So this industry is highly competitive due to its low switching costs and basically non-existent brand loyalty, and substitutes are a constant threat. On the other hand, it's also hard to establish economies of scale due to the complex structure of the industry, which is a barrier for new entrants. Also, the online platform is fairly new. So where does PayPal stand in all of this? Well, PayPal, as seen on the screen before, qualifies as a processor and a gateway, though from recent trends, it also seems to be wanting to transition into a digital wallet service. It is the lead online transaction service with 361 million active users. So for a little bit of context, many other prominent digital wallet services you may have heard of, including Google Pay and Apple Pay, have yet to reach even 100 million users. Also, PayPal has a whopping 54.5% of the market share, leaving second place behind at 18%. Furthermore, as you may have known, the recession caused by COVID-19 hit all parts of the economy pretty hard, but PayPal is an exception to this, as it's seen its stock even double since before the crisis. In any case, COVID-19 has largely sped up digitalization by getting people more comfortable with online functions, and this will definitely benefit PayPal. So for competitive positioning, I believe PayPal has a wide moat, or at least a widening moat, that is strongly supported by its network effect. So PayPal has a two-network strategy that connects merchants to customers, and also relies on strategic partnerships with payment networks and acquirers. Some of the more well-known ones include Visa, MasterCard, and American Express, as well as just influential companies in general, such as Instagram. And this network is likely to grow even more in the future with the increased emphasis on e-commerce. Also, PayPal has achieved economies of scale. So PayPal has shown extremely strong financials in the past 5 years, as shown by its 100% increase in revenue, 200% increase in net income, 100% increase in assets. It has an unlevered free cash flow of 5.2 billion and an operating cash flow of 5.9 billion, which shows that it's not generating or financing its day-to-day operations from debt. It's highly profitable, as seen by its ROE of 22.8% to a sector median of 6.3%. And not only is PayPal outperforming its peers now, it will continue to do so in the future with a projected forward revenue growth rate of 20.4% to a sector median of 8.7%. Also, I should add that PayPal has been around for 20 years and is still able to show such strong financials. So for my valuation, I used a relative valuation analysis as I saw that PayPal had a higher than average PE ratio. So I compared PayPal to companies with a similar market position in industry, such as like Alibaba and Google. I also gave PayPal a deserved premium for 10% because of its market share, and again, because it's the lead online company, which will become more relevant in the future. I chose the relative valuation analysis over the discounted cash flow analysis, even though the latter gave me a higher intrinsic value per share because I found it hard to approximate PayPal's terminal growth rate. And finally, I ended up with an intrinsic value per share of $344.80, which is a 47% upside. However, I should mention that even without the deserved premium of 10%, PayPal would still have a 30% upside potential. That being said, there are definitely risks in investing in PayPal, with the first risk being that PayPal seems overvalued. So it has a higher than average PE ratio, which I believe was more due to its strong financials, high growth rate, and therefore high investor expectations, rather than it actually being overvalued due to a decline in performance. Nevertheless, since we can't predict what will happen in the future, potential investors should keep this in mind. A second risk would be the increased competition. So even though PayPal has had the first mover advantage when it comes to online services, many other companies are beginning to follow suit. For example, traditional payment companies such as Visa and American Express are now also offering digital services. And one of PayPal's main rivals, Square, has also seen a similar growth in the past year with a 148% increase in stock price, even though it still has ways before catching up to PayPal. Nevertheless, PayPal definitely has to keep its foot on the gas pedal to stay ahead. A third risk would be the end of COVID. So as alluded to before, much of PayPal's growth in the past year could have been due to the fact that people were only limited to online shopping because of quarantine. So it's unknown whether or not PayPal will be able to maintain its current momentum once things go back to normal. And a final risk would be a change in leadership, since PayPal's current CEO, Dan Schulman, is already 63 years old this year, which is nearing the traditional age of retirement for CEOs. So for ESG, PayPal is ranked in the 83rd percentile as compared to 18,000 of its peers, and it either performs with or above the industry average. And PayPal's main ESG strategies are centered around social innovation, employees and culture, environmental sustainability, and business practices, with the pie chart on the screen being how much priority PayPal gives to each. And then this is just a more in-detailed graph of PayPal's strategies. So my final point is about cryptocurrency. So PayPal has always been in support of crypto, and as of late March of 2021, it'll now allow its users to pay with Bitcoin, Ethereum, and Litecoin. So with this, PayPal is definitely making the decisive first step into a cashless society, which is basically a society that has eliminated the need for physical money. Now, while it's understandable why many people might find this idea daunting, as I'm sure it's hard to imagine a world without the paper money we're so used to, people should also keep in mind that the form of money has changed many times in the past to cater to the needs of a changing society, and our society is definitely changing. E-commerce has grown from 7.4% to 14.3% of total retail sales from 2010 to 2018. And total internet users has increased from 413 million to 4.66 billion in just the last 2 decades. In other words, half the globe is online now. So I have reason to believe that money will become digitalized in the future, and that this change isn't even as far off as we may think. For example, in China, WeChat Pay, a digital wallet service, is already one of the top payment methods with over 1 billion transactions per day. And the last time I visited China 2 years ago, many restaurants and businesses would only accept WeChat Pay due to its convenience. Therefore, it's highly likely that the world will move online one day, and that it's only a matter of when. So PayPal's only taking the first step into this direction. So to sum it all up, PayPal is clearly the top choice amongst its peers. It has a strong market position as shown by its large base, which not only allows it to achieve economies of scale, but also benefits its two-sided network. And this complex network built off of key acquisitions and partnerships also protects PayPal's market share by building an economic moat. PayPal also continues to have a strong financial performance in the past few years. Furthermore, it's already 20 years old, which means that it's not necessarily a new company, so most of this growth is steady. Finally, not only is PayPal staying ahead of the game now, it will continue to do so in the future by becoming the pioneers of a cashless society. Where other companies hesitate, PayPal gets ahead. Therefore, I would rate PayPal a strong buy. Thank you very much for listening.
Great, thanks so much, Elizabeth. All right, I have Kristen and Kevin. Kristen, both Kristen and Kevin, you both get one question each. Kristen, did you want to go ahead and start?
Sure thing. Elizabeth, great job, energy, and I think we all have clicked on PayPal probably one too many times over the last 18 months by not going into retail brands. I would love you did a really good job around the strategic partnerships and talking about the sector of where they've embedded themselves competition wise. In terms of looking at some of maybe even the larger banks that they're working with, or a Visa and an Amex, can you just talk a little bit about just more of the competitive dynamics? And I say this, and I was actually, you made a good point on their EBITDA margins of 20% versus a sector average of 13.5. How do you build and think about the competitive threats as, again, working for a large bank, we move into more digital, and some of their strategic partners could actually turn into more competitors, and does that kind of threat the margin outlook? Would love to just hear your thoughts on that.
Yeah, in terms of PayPal's partnerships with these banks, I do believe that they could become potential competitors in the future if banking also moves online, and as PayPal and digital transactions are drawing in more and more customers. And even though Visa and these companies may have larger networks than PayPal, I still believe that PayPal does have the advantage when it comes to online services because they're just so entrenched. And I also believe that these companies, PayPal has had traditionally has not had that much competition with these companies because they usually turn their competitors into potential partners. So I don't think it'll be that much of a threat or threaten PayPal's position too much. Even if the payments ecosystem does kind of digitalize in the future, they're still kind of in separate spheres, if that makes sense.
Great, super helpful. Thank you.
All right, Kevin, did you have a question for Elizabeth?
I do. Elizabeth, first of all, great job. And I spend my days talking about mobile payments and in emerging markets and places like China, which you touched on, where both Alibaba and Tencent have massive mobile payments platforms. How big and what would you say about the international opportunity, and in particular, the opportunity for PayPal in emerging markets like China, Brazil, India, et cetera?
Yeah, great question. So actually only half of PayPal's revenue or users are from the United States, and they also have the leading market share in most other international companies. But I think the one place where it might be harder for PayPal would be China, because of how entrenched and how powerful that Tencent and Alibaba are right now. I think in terms of the Chinese market, PayPal might focus more on providing maybe foreign or international markets or goods to Chinese customers in businesses, instead of just outright competing with Tencent and these domestic payment methods, if that makes sense. So, but PayPal also has recently gained full control of one of China's digital payment companies, although a small one. So I guess that could also help.
Okay, great.
Great. Thank you so much, Elizabeth. Great job.
Great job. Thank you.
All right. Next up, I have Jasper Lau from Renaissance College in Hong Kong.
Hi, can everyone hear me?
Yes.
Oh, thank you. Hi everyone, my name is Jasper, and today I have a fantastic idea for you, as I'll be pitching a stock Logitech International SA. The current price as of 31st of March is 104, and I believe there's an opportunity for a 59% upside. When you think of Logitech, do you think of mouses and keyboards? Well, no, Logitech is not just about that. In recent years, Logitech has expanded into categories like streaming, headsets, video conferencing, and more. Logitech's products can be separated into 5 key categories: creativity and productivity, gaming, video collaboration, music, and smart home. Logitech owns a diverse portfolio of companies, including Logitech, Logitech G, Astro Gaming, Streamlabs, Ultimate Ears, Jaybird, and Blue Microphones. If we look at the consumer technology electronic industry, it was valued at around $1 trillion in 2019, and it is expected to grow at a compound annual growth rate of over 7%. Note that the industry is highly competitive, which leads to a decrease in product life cycles, and companies have to innovate and compete against each other. In general, COVID has had a positive impact on the industry, especially on the computer and peripheral segment, due to consumers working from home. Therefore, they have to rely on consumer electronics as a means of communication. Depending on the segment, the categories that Logitech are in are projected to grow at a compound annual growth rate between 9 to 17%. The key competitors of this industry are Sony, Microsoft, Apple, and Samsung. If we look at the financial history of the company, the revenue has been increasing around 300 million year over year and surged in the last 12 months as COVID hit. The EBITDA growth in margins as well as the operating income and margins also have been increasing at a steady rate year over year, and the free cash flow has been positive for the past 6 years and has been at its highest point during COVID. Leading to my investment thesis, Logitech exceeds consensus expectations through the following 4 points: attractive fundamentals, growth opportunity, brand name and diverse business model, as well as scaling power of Logitech. So to my first point, attractive fundamentals. In fiscal year 21 quarter 3, Logitech announced that its revenue rose 85% year over year, its operating income grew 214%, and its adjusted gross margin grew from 37.6% to 45.2%. If we look at Logitech's fundamentals, its DE ratio is at 0.59, its net debt to EBITDA ratio is negative 8.26, its return on equity is a staggering 54.51%, and its EV to sales multiple is at 3.66. Despite Logitech's excellent quarterly results, excellent fundamentals, little debt, high return on equity, if we look at the top graph, we can see that Logitech's PE ratio is at its all-time low at 19 times. I mean, can you believe that? The bottom of the graph shows that the stock price is not reflecting earnings. Now, some might come into the conclusion that the industry is trading in the same rates, but that's not true. According to the comparable company analysis, the PE ratio of Logitech is significantly lower than its peers, despite having the most growth. The bottom shows that the EV to revenue ratio is low compared to its industry peers, so some might wonder now, why is the price not reflecting earnings, which leads me to my second point. The market thinks that demand for video collaboration, creativity, and productivity and gaming peripherals will plummet post-pandemic, while I believe that companies will move into a more hybrid work setup post-pandemic, and there are 4 long-term secular trends that will lead to significant growth for Logitech. Firstly, it's increases in workspaces. Then it's video calls replacing audio calls, and then gaming will become the most popular sport in the world, and entertainment will shift from more big companies like Netflix and Disney to each other like YouTube and Twitch. Moreover, there are huge growth opportunities in untapped and emerging markets, especially in China, where esports is becoming more and more popular. Moreover, gaming peripherals is also a huge opportunity, as Logitech is currently top 1 in the peripherals gaming market, which is poised to grow at a substantial rate. Logitech's partnerships with League of Legends, esports teams, influencers, tournaments is a huge competitive advantage. Last but not least, Logitech is expanding its demographics to target female and adolescent demographics, which is also a huge untapped market. To my third point, brand name and diverse business model. Logitech, as a leader in the peripherals industry, similar to Apple, Logitech is associated with high quality, reliable, simple yet effective products, which allows Logitech to charge a premium. The brand name is only going to continue to expand as Logitech creates more products and partnerships. The diverse business model from merger and acquisitions and also expansion into new categories creates a wide customer base for Logitech. So on to my fourth point, scaling capability. So ever since the pandemic, Logitech has been generating more revenue and free cash flow, and with a current ratio of 1.9 and little to no debt, Logitech can definitely scale its business through increasing marketing, research and development, or even new M&A deals, which will definitely lead to future growth. Onto the competitive positioning. Logitech has a narrow moat. Now, it is important to note that it is hard to establish a competitive advantage in this industry due to the short life life cycles of products and competitiveness. So in terms of intangible assets, Logitech has an intellectual property portfolio of more than 750 patents and a huge brand name, as it really talks about. And in terms of cost advantages and efficient scale, Logitech produces its products in large volumes as it is an industry leader, and which allows for economies of scale. And Logitech also has automation expertise, with 30% of its production being automated. And if you look at the Porter's 5 forces, the bargaining power of customers is low, intensity of competitive rivalry is significant, bargaining power of suppliers is insignificant, threats of substitutes is moderate to low, and threats to new entrants is low. Now on to my intrinsic valuation. So to calculate the intrinsic value of the stock, I use the perpetuity and exit multiple DCF method to calculate the target price. So I first projected revenue, gross profit, and finally the future unlevered free cash flow for a more accurate representation. And then I count for the exit multiple. I use the median EV to EBITDA from my comparable company analysis, and also for the perpetuity growth rate, I chose a conservative 1.5%. And for my discount rate, which is the weighted average cost of capital, what turned out to be 7.97%, which also turned out to actually be the cost of equity, or CAPM, because Logitech has no interest expenses. And then I calculated the enterprise value to find the equity value per share. Finally, I conducted a sensitivity analysis to see how changes in exit multiple, perpetuity rate, and weighted average cost of capital will affect the target price. Now on to the investment risks and mitigates. Well, Logitech is in a fast-paced industry, as already elaborated, and also there are definitely risks to China and US relations, as well as COVID. And also, finally, threats of new substitutes and new entrants, especially large corporations like Microsoft, Sony. However, Logitech is already in the process of expanding into new categories like AI and the virtual or augmented reality space, and is constantly developing new products and innovations. And onto the ESG factors, Logitech is an industry leader in the environmental space, as it designs a large percentage of its products out of recycled plastics. And it's also the first consumer electronics company to provide detailed carbon impact labeling on its products. Logitech is also on the Dow Jones Sustainability Index and FTSE Good Index, and has won numerous sustainability awards. Moreover, Logitech has multiple initiatives like LogiCares, which focuses on giving back to the community, and also has partnerships with Girls Gotta Run, Girls Who Code, HopeCam, and more. Moreover, Logitech has supported the community during the pandemic through donation, making masks, and also video-enabled telemedicine cards in Wuhan, and more. Moreover, Logitech has corporate governance principles and code of conducts, and Logitech recently announced a diversity pledge on commitment to diversity action. Logitech is growing an inclusive culture, supporting underrepresented employees, and changing the way we do business. So now on to the update since April, which was the last time I pitched the stock. So they filed their fiscal year 21 10K on the 12th of May, and the key highlights were the net sales increased 74% from fiscal year 20 to fiscal year 21. Then its operating income tripled to 315% year over year. And it also announced a 10% annual dividend increase for fiscal year 22 for its stock. And also the board recently approved an increase in the share buyback program from 250 million to 1 billion, which definitely shows that the company is confident with its future growth and shows that the stock is undervalued. And the stock price as of today, I just checked today, was at $122. And when I actually did the stock pitch competition last Saturday, which was just a few days ago, it was actually at $110. And I still feel like the stock is a strong buy due to the points above, and also due to the fact that my investment thesis is still intact. Thank you so much. I'm open to any and all questions.
Thank you so much, Jasper. That was great. I'm going to default to Deepika and Greg. You guys get one question each for Jasper. Deepika.
Great. Yeah, great presentation, Jasper. Thanks so much for joining. I think when you started the presentation by saying that you were expecting a price appreciation of 59%, I was hooked. I wanted to hear your argument. So When you showed the DCF analysis, the numbers pan out. I did see that in the kind of earnings expectations and the gross margin expectations for future years, you did kind of bring them back in line with 2019 and not maintain them at the COVID level. So that's great. In terms of when you did the DCF analysis, did you include any assumptions around kind of the acquisitions or kind of the growth ambitions that Logitech has, and kind of how did you consider those as part of your analysis?
Yeah, thank you so much for your question. So for basically my DCF model, I did take into consideration, as you talked about, the acquisitions and also the future growth opportunities. And I actually, to be honest, I was very conservative with my DCF because obviously it's hard to predict the future, and this can be shown as I actually used a perpetuity growth rate of 1.5%, and usually in DCF models you would use somewhere between 2 to 3%. So yes, I definitely feel like this stock has great opportunities because, as you can see in my DCF model, I was very conservative, and also the stock price is currently at $122, which was when I actually started the stock pitch. I didn't think the stock price would go up like 20% in a few months, and yeah.
Great, thank you. Greg, did you have a question for Jasper?
Yeah, Jasper, again, great job. A couple things for you. I think one, I'm always interested to see where idea generation comes from. What made you sort of key on this stock as being mispriced? Number one, and then number two, I'm really interested in your statement that you were conservative in your DCF. I want to know why, as opposed to being just trying to be accurate to what it is that you forecast. And I couldn't help but see, a company who's come off of significant growth, and you're projecting it under a sort of 5-year hold period to be sort of flat at the EBIT level. That doesn't normally correlate to stocks that do incredibly well. So I just wanted to sort of check in with what makes you excited about a company whose profits you think will be pretty flat.
Yeah, so for my EV to EBITDA ratio, actually, the exit multiple, I actually used the industry median. Now the mean was actually higher, however, because there was one certain company who had like a super high multiple, therefore I used the median. And for future growth opportunities, yes, I definitely believe there are many future growth opportunities. As I talked about in the slide, you can see that they definitely have very attractive fundamentals. However, and they also have like such a good growth. However, the stock price is not reflecting their earnings, and I think this is mostly because the consensus believes that there are less growth opportunities, and the growth that Logitech has shown this year and last year, the huge growth rates are not going to sustain in the future. However, I feel like the consensus is definitely wrong with this point, because there are definitely huge growth opportunities for Logitech, as I said, especially increase in workspaces due to the pandemic. As you can see in my slide, there are numerous large corporations, like for example Microsoft. They noted that 70% of workers actually wanted to be able to work from home after the pandemic. Therefore, increase in workspaces will definitely drive the future growth. And also my other three secular trends, which is video calls replacing audio calls, gaming becoming the most popular sport in the world, and entertainment shifting from big companies to small companies. And also there are definitely huge growth opportunities in emerging markets and also new demographics. Thank you.
Great, thanks so much, Jasper. Great presentation.
Thank you.
All right, moving on, I have Ray Vasquez from YNA High School in Hawaii.
Give me a second. Oh, can we see that?
Yes.
Okay. Hello, my name is Ray Vasquez. I'm here to introduce you to stock Johnson & Johnson. Now, as of March 31st, I had a share price of $162.83, but I'm definitely here to show you this stock should definitely be valued much higher than where they're originally at. Therefore, my target price of $231.22. So driving straight into the company overview, Johnson & Johnson is a diversified healthcare giant. They operate on more than 260 companies worldwide, and they are the largest of all pharmaceuticals with a market cap of $434.42 billion. They operate on 3 divisions, and that's being the pharmaceutical drugs market, the medical devices field, and the consumer health products field. As well as that, they own well-known brands such as Band-Aid and Aveeno. Now with sales, revenues for J&J were at $82.58 billion, and that's with an increase rate of 0.6%. This is driven by their solid performance in the 3 areas that I just mentioned. Their customer base ranges from the average store buyers who buy Johnson & Johnson products straight from the shelves to anybody in the medical field, hospitals, doctors, surgeons who buys their medical devices, products, and whatnot, or even health insurance companies who buys who pays for the insurance for pharmaceutical drugs. Their shareholders consist the market position, they are number 1 in the healthcare field by the market cap, as I said. So they manage the largest portfolio of pharmaceutical drugs, consumer health products, and medical devices. So, and finally, with the shareholders, their shareholders consist majority of institutional investors. So, for example, BlackRock Funds Advisors and SSGA. So investment thesis. So I'm saying buy Johnson & Johnson with a target price of $231.22 for the following. So for one, they serve the healthcare market with important and unique products. So they address things like colds, sicknesses, severe things like pain management and vaccines and cancer, and a lot more. So overall, their products are not easily found elsewhere. They have an unmatched brand recognition in the healthcare industry. So this company itself, they're pretty well known. It's out there. And alongside that, they own a bunch of companies that are well known too. So we see that as a big advantage because you're much more likely to buy things that you're familiar with. Various doctors that will prescribe things that are from Johnson & Johnson's pharmaceutical drugs and whatnot. And finally, they own a wide range of companies. So piggybacking off of what I just said, they own a bunch of brands under their name. And we see that as an advantage because they're collecting all this revenues from multiple different sources, from all these different brands and whatnot. And alongside that, they're also collecting revenues from their 3 segments that they serve under. So overall, this business is so diversified. And because they're so diversified, it's a much lower risk to invest in than a company that's concentrated. So industry analysis. So with pharmaceutical, they lead. So first off, they lead the market in 3 divisions. So with the pharmaceutical, this division focuses upon 5 therapeutic areas, and that is the brain, the heart, the immune system, cancer, and diseases and vaccines. With their medical device field, this continues to focus on standard care through physician and patient-centered products. So anything maybe in the bones, the muscles, and the visions. Finally, with consumer health, this division helps improve personal health. So anything with products in skincare, self-care, essential products. On the side, we see the 4th quarter 2020 highlights of Johnson & Johnson. So Johnson & Johnson has a competitive edge in the following. With brand, aside from them being well-known and their companies and brands that they own being well-known, their brand engages in research and development and manufacturing, manufacturing and sales of products in their healthcare field. For their economies of scale, this company is a market leader. They are a market leader in multiple healthcare areas, and they benefit from the economies of scale, and that's including manufacturing and marketing costs, and just overall, them just being able to easily launch new products. Innovation. So they have an unparalleled scientific expertise. They have many doctors, scientists on their team to help them develop innovation, create innovation. For execution, they have 28 platforms and products that had $1 billion in annual sales reported in 2020. And how this shows execution is that they're able to recognize an opportunity within their products and actually succeed by marketing and advertising and selling it out there. Finally, with people, they are powered by people. They have, as I said, they have many doctors, many scientists and researchers and developers that contributes to Johnson & Johnson as a whole. Now for revenue drivers, so coming in first, the most that they generate from is the pharmaceutical field. So they generate $45.6 billion in sales. So this growth is primarily driven by their anti-cancer drugs portfolio. So anything in the anti-cancer drugs area, so Imbruvica and Darzalex drugs. Their medical device business, it garners up to $23 billion, and this is led by any means of surgery, such as bone surgeries and treatments, and Synthesis that offers digital surgery actually. For the consumer health products, this contributes to $14.1 billion in sales, and this is driven by their oral care, skincare, health and beauty products, and much more. So financial analysis. So we're expecting them to grow revenues at an annual rate of 11.4%, and for profitability, we're expecting to recognize a net margin of 27.4% all in 2021. Now, here's how I valued my target price. So starting off with the share price of $162.83, we also have the market cap of $434.42 billion. So from the market cap, we subtracted cash and add the debt, and therefore getting the enterprise value of $445.36 billion, all until we get the multiple for Johnson & Johnson at 5.39. Now at this part, we take the competitors of Johnson & Johnson, such as Eli Lilly, with a 7.81 multiple, Estee Lauder companies with a 7.61 multiple, and Stryker corporations with a 7.11 multiple. So altogether, the peer average of the customers were 7.51 multiple compared to Johnson & Johnson 5.39 multiple. Dividing that from each other, they get a 39% premium. Therefore, my target price of $231.22 is 39 above of what they originally had, and at a target price that competes with their competitors. Now, investment risk would include legal expenses such as drug abuse, faulty hip implants, asbestos contaminations, and whatnot. Following up, we have COVID-19, so limited procedures in their medical field. And finally, with competition, they have competition with really big companies such as Merck and Pfizer, for example. Now, for threats to new entrants, they're pretty low, and this is due to them being hard to replicate because of how big their business is. Bargaining power of suppliers is low as well. This is due to them, again, being how large they are. They also develop really dedicated suppliers, loyal suppliers to this business, who are dedicated to them, as I said. The threat to substitute in products and services, this is moderate because other companies, competitors that Johnson & Johnson has also does have pharmaceutical drugs, medical devices, and consumer health products. Now, for their the rivalry among existing firms, this is pretty moderate as well, because as I said, they have rivals, and the rivals are pretty big, and they own a lot of recognizable brands as well, such as L'Oreal, Procter & Gamble, and Unilever. But despite that, Johnson & Johnson has been around long enough to establish trust with their consumers and customers. Finally, with bargaining power of buyers, this is low, and this is due to them being able to just create new products. And as I said, they're innovative, and they have a large customer base that contributes to the bargaining power of buyers. Now with ESG, their ESG includes good leadership that I will be explaining briefly on the next slide, and investment in employees and environmentally friendly packaging. So on the bottom, we see examples of Johnson & Johnson's environmentally friendly packaging. And then on the side, we see a variety of different peoples from different backgrounds, some of them coming into internships and some of them coming from military and just employees and whatnot. So management and government. So we have Mr. Alex Grossby, who's been with the company since 1994 until in 2012 when he's been named and labeled chairman and CEO. Overall, it just goes to show that this man and alongside these other people are very dedicated with Johnson & Johnson. So let's wrap this up. I chose to represent a stock that I knew, and Johnson & Johnson has been around for generations, starting from maybe grandparents to parents as well. But overall, they're coming into the newer generations. Their products are still being used here in the new generations. Now, for those of you who are able to, please take out your phones and use your phone cameras to scan the QR code at the top, if you can. It just shows that, as you can see, it shows a graph. This graph shows the progress of the stock of Johnson & Johnson from way back when and to the now current time. So overall, what I'm trying to say here is this stock has been growing as you can see from the graph, they've been growing. So that being said, buy Johnson & Johnson.
Thank you so much, Ray. I'm going to go to Jeff and James. They each have one question each. James, did you have a question for Ray?
Absolutely. Fantastic job. Thank you very much. And certainly a very well-established and well-known company, especially in home market in the US. I'd like to ask you to expand a little bit about your thoughts on how the company is expanding globally, because of the fact that it's fairly well established in home market, and the population growth has been strong outside of the US. Potentially, the new drivers, of revenue going forward will probably come from relatively new areas that they're going to penetrate into. Any thoughts on or any idea on the overall penetration globally, and also the revenue share between US and global markets?
Well, with that, I could say that Johnson & Johnson, I didn't mention this in the slides, but they have been working with third world countries. So a lot of their products are being produced out there to other countries as well. They have probably online markets that they have, and those products are out in a global scale that many people can buy from all over the world. And so they're collecting all this revenues from all those different sources, as I said. I can also mention for this question, I can mention on the financial analysis. So with the growth, they're expecting to grow an annual rate of 11.4%, and that's just being able to rebound from the COVID pandemic. So from that, as we said, Johnson & Johnson is from a global scale. So they'll definitely, from the pandemic, if they're rebounding from that, they will collect revenues from all that areas as well. And whatnot. And yeah, can we move on to the next question?
Yes. Jeff, did you have a question for Ray?
Yes, Ray, thanks for the presentation. I really enjoyed hearing your insights, and I think your framework for how you think about the business was really, it helped me understand it. And I know this company far less than you do. I was curious about just thinking, some of the competitive strategic factors you outlined. When you were looking at the Porter forces, it looked like threat of substitute products and, rivalry from existing firms were both, you kind of score them evenly. And I guess I just wanted to peel back a little bit. And if you had to pick, think the next, 3-4 years, between those two, which do you think has a higher likelihood of being a risk, and how do you get confidence about J&J seeing through it?
For this, I can say rivalry among existing firms, that over the years could be more of a turn into a risk, because as I said, they have a lot of companies that are really big and owns a lot of really recognizable brands as well. So that can be a risk. But however, I'm very confident in Johnson & Johnson, because Johnson & Johnson has been around for a really, really long time, probably like in the 18th century. Only now they're starting to being recognized as all that. So from that, being around for that very long time, they're able to develop and make all these really loyal customers to their name and to their brands.
Thank you.
Thank you.
Great, thanks so much, Ray, great job. All right, and last but definitely not least, we have Kevin O from Great Neck High School in New York.
All right. Hello, everyone. We all probably know Alibaba, one of the biggest e-commerce platforms in the world, and Tencent, the largest gaming platform in the world. What if I were to tell you that another company will soon become the next Alibaba and Tencent together? My name is Kevin O, and before I begin, I would like to say thank you for this amazing opportunity. Today, I'll be presenting Sea Limited. Sea Limited has been growing over 100% in the last couple of years and is expected to become the next Alibaba and Tencent of Southeast Asia. I rate C Limited a buy with a price of $213 because my valuation is currently lower than the market cap. C Limited lies in three prospective industries. Garena in the digital entertainment industry, which is forecasted to grow at a compounded annual growth rate of about 14% from 2020 to 2025. Shopee is in the e-commerce industry, in which the market volume is expected to reach $153 billion in 2025 from just $38 billion in 2019. C-Money is in the fintech industry, which is expected to grow over 22% from 2020 to 2025. By localizing, C can meet diversified demands and complicated cultural, economic, and political backgrounds in order to operate smoothly. Supported by the profits of Garena, their cash cow, the e-commerce and fintech segments could grow at a 3-digit growth rate. Comparing the first quarter of 2020 and 2021, Shopee, Garena, and C-Money grew over 250%, 111%, and 396% in their revenues respectively. One of the largest shareholders is Tencent, who owns about 30% of C's stocks. Tencent has provided exclusive resources to gesture in popular games for Garena to introduce and distribute, guaranteeing its leading position in the digital entertainment sector. C has integrated its digital financial platform C-Money into the other platforms, completing the business cycle of online games and e-commerce. The integration will not only realize economic of scales to lower down unit costs and expenses, but also consolidate the ecosystem by diversifying its usage of daily lives and opportunities. C Limited owns 3 online platforms in all 3 different segments. They are Garena in the digital entertainment segment, Shopee in the e-commerce segment, and C-Money in the digital financial segment. These 3 segments coexist to create an ecosystem where they all work in correlation with each other. The revenue of C's companies have been growing increasingly over the past year and has skyrocketed their revenues. The cash flow operation is no longer negative, which means that the company is slowly starting to accumulate cash due to their heavy expansion. The margins have also increased steadily, which is a good sign that the company is growing. Garena is the leading gaming platform and distributor in Southeast Asia with over 80 million active daily users. The gaming industry is forecasted to grow at a 14% compounded annually during 2020 to 2025. Garena's moat is focusing strongly on marketing at the local level by understanding the trends that each region has. They use a freemium model where they allow users to play for free, and the revenue is generated from the in-game purchases, such as upgrades from skins and stuff like that. Majority of the games come from their partner Tencent, which they distribute to Southeast Asia. Tencent is the largest gaming platform and developer in the world that provides games to Garena. Shopee is the leading online e-commerce company in Southeast Asia by the most downloads, average monthly active users, and time spent on the app. The e-commerce industry is forecasted to grow over 14% compounded annually during 2020 to 2027. Shopee uses a model of C2C and B2C to encourage individuals to sell products on their platform with a very small charge, while increasing their charge with larger corporate sellers on their platform. Shopee's moat is focusing to understand the values, cultures, and trends that each region holds in order to use the localization method and to meet the diversified demands. As you can see in the picture on the top right, Shopee is the most downloaded app in almost all the countries in Southeast Asia. C-Money is the leading digital payment and financial service provider in Southeast Asia. The digital financial service industry is expected to grow over 22% compounded annually during 2020 to 2025. C-Money is successful because it's used to close the transactions for Garena and Shopee. It is one of the only 4 banks in all of Singapore who have the full bank license that allows them to go digital, which differentiates them from their competitors. C-Money is used in other C-Limited platforms to make transactions such as Garena and Shopee. C-Money has over 23.2 million quarterly active paying users and has over $7.8 billion in total payment active volumes. The global game industry is forecasted to grow at a compounded annual growth rate of about 12% during the next 4 years due to the rise of accessibility in smartphones, which has allowed many users to access online games. The gaming industry has also recovered very quickly from COVID-19, as many people turn to entertainment as a form of entertaining themselves during stay-home orders. The global e-commerce industry is projected to grow at a compounded annual growth rate of about 6.29% from 2021 to 2025. The e-commerce industry was not significantly hit by the pandemic, as many people turned to e-commerce when the pandemic hit due to the stay-home orders and the in-person regulations. In 2020, there was a 44% increase in consumer spending, although COVID-19 hit. And this just shows how well the industry is good at sustaining in situations like these. The global fintech value is expected to grow at a compounded annual growth rate of about 24% from 2020 to 2025. The fintech market is valued at $5.5 trillion in 2019, which is one of the fastest growing industries that have allowed users to from around the world to invest online, buy cryptocurrencies, and have an online bank. C Limited has been using profits generated by Garena to finance expansions of Shopee and C-Money. By both Shopee and C-Money are currently in the early stages of development and require a hefty amount of investment in order to maximize the company's capability in Southeast Asia. The cash out method in their ecosystem has made them less risky by not using cash from outside investors, rather from their own companies. The research and department team has focused on understanding the diverse region because they know that each region has a different cultural value, influence, and regulations. C-Money has been used to close transactions for Shopee and Garena, which can support the expansion by providing applicational scenarios. By integrating C-Money into transactions, this allows both C-Money and other platforms to grow as transactions would benefit both platforms. The ecosystem will guarantee a solid customer base with high stickiness, and with enough data from the users, this will give the marketing team more opportunities such as consumption loans. I rate the bargaining power of customers to be strong because C Limited continues to have a strong loyal customers from Shopee and Garena, and therefore the suppliers are willing to accept Shopee's requirements as they need exposure to a large customer base. I rate the intensity of competitive rivalry to be moderate because both digital entertainment and e-commerce are competitive markets with several large players and many tiny ones. By building up the ecosystem and carrying out the successful strategy, C can maintain the leading position in the greater Southeast Asia region. I rate the bargaining power of suppliers to be strong. As a platform with millions of users, C Limited has the power to choose from plenty of suppliers. There is no accepting that the bargaining power of Garena is somewhat low because its main supplier is Tencent, which is also their partner. I rate the threat of substitute as insignificant because shopping online will be the trend for young generations, especially after the pandemic. People will have formed this habit. With the development of 5G and smartphones, mobile game will occupy most of the game industry. I rate the threat of new entrants to be insignificant because creating another e-commerce game developer and fintech ecosystem would require a great amount of effort, as Shopee, Garena, and C-Money have already established a large customer base with a high stickiness. This is the forecast of the next 5 years for C Limited. I find that the net income for the next 2 years are negative, and therefore I've decided to use the PS ratio as a comparative method. I value the company to be around $97 billion for e-commerce and Garena by using the PS ratio. I use a different method to value AirPay as the newest addition. I compared it to Alipay, which was valued around $40 billion in 2015, which is at a similar stage where AirPay is right now. I value AirPay to be around $20 billion, half of Alipay, because it's mainly in Southeast Asia, which has half the population in China, which is around 600 million in Southeast Asia and 1.3 billion in East Asia. With all these three segments together, I value the company to be around roughly $111 billion. C Limited's strategy in reinvesting the revenue back into the company has led the company into a net loss. The company is not certain in its ability to generate a net profit or cash flow from Shopee and C-Money platform because they plan on heavily continuously reinvesting their profits back into the company. C's partnership retention has made C rely on Tencent resources such as the games, and in the future, Tencent were to not be partners, majority of the revenue for Garena would decline as majority of the revenue source comes from Tencent. There are many competitors in Southeast Asia, and one of the biggest competitors is Lazada, which is backed by Alibaba, one of the biggest e-commerce companies in the world, which provides Lazada with a large amount of capital. The digital fallback license has allowed C-Money to go digital, which has allowed payments to go paperless, which will be helpful for the environment. C has a large $100 billion company, which could potentially create jobs for Southeast Asians, and that maybe bring new business and tech into Southeast Asia. C-Money has grown incredibly in 2020 with their stocks, and as a result, it has returned about 5 times the return. So to conclude, the pandemic has greatly affected everyone during these difficult times. We have all turned to online-based platforms to help with our daily lives, and in doing so, C Limited has grown incredibly from their increased users from the online world. I rate C Limited a buy because it's just at its beginning and it's reaching beyond the limits already with its incredible growth. Thank you for listening, and now I'll be taking questions.
All right, great job, Kevin. I have Kevin Carter and Kristen with questions for you today. So Kevin, did you have a question for Kevin O?
I think you're muted.
Sorry.
No worries, Kevin.
Kevin, great presentation. And C Limited is a company near and dear to my heart. I wonder if you could comment on the competition in the region, which is seemingly intensified in the last month or two as the Singapore competitor Grab, or the Singapore-based competitor Grab, is now seeking to begin trading publicly as part of a SPAC. And perhaps more importantly, the combination of Indonesian-based Gojek and Tokopedia, which looks like it's going to happen. So how would you think about the competitive position going forward, in particular with Gojek and Tokopedia combining?
Well, Grab is not doing a similar business strategy as C Limited is. So it would not be like a really big threat in the future. And currently, like C Limited has like already established their like large customer base, and like majority of like Southeast Asian people there are like in the young 30s. Like the 30s, like millennials make up like a large population of Southeast Asia, right? And therefore, many people are willing to remain loyal to C Limited's companies as they've established their customer base for a long time there, and therefore like a new entrant will entering Southeast Asia will be harder because people tend to be like follow their footsteps into like familiar companies such as C, and therefore it's not like a big threat. And the other company, the ecosystem is quite different compared to C Limited. They are on C Limited focuses strongly on games and online shopping, and therefore that's like different from the company. So C Limited with like focusing on different things, like it won't be like a big threat, different products, different things made, different like target markets and different stuff. So I don't believe like big threats will be coming in the future anytime soon. As I said before, like their customer base has already been established. People like not change a lot, and yeah. And so if other players want to enter, they will have big problems because, you know, as I said before, they have like big competitions, and if they even have problems, they would also have problems with diversifying the backgrounds. C Limited has established their strong localization method and marketing at the local level. They are like, as you can see, like in the slides, they have like different apps personalized for like each region. Like Indonesia has like Shopee, and like Thailand has Shopee TH, which is personalized just for Thailand. So it would be really hard for like other areas, other like competitors to enter.
Okay, great, thank you.
Great. Kristen, did you have a question for Kevin?
Sure, and great presentation and fascinating in terms of your comment at the beginning around Tencent. And obviously we know Tencent is the 800-pound gorilla. Can you just go into more detail around how this is a longer-term competitive advantage? Does Tencent have further desires to use this company as growth in other regions, or does it make it that competitive advantage? How do you see the Tencent partnership either building or growing as a way that C can differentiate itself?
Well, Tencent is like the largest company, like gaming wise, in the world, and they have like accumulated a large amount of like users. Many popular games in the US are Tencent, like I can't name the top of my head, but like I know there's like a bunch of like games where like you open it up and the word Tencent comes. And Tencent being a partner with like C Limited in Southeast Asia region will allow C Limited to they like build their partners really well. Tencent is focused strongly in China, and in that, like they're like focusing in China, they won't really know Southeast Asia that well. And therefore partnering up with Southeast Asia, large companies such as Garena will allow the company for C Limited and Tencent to grow cyclically, as they're both like, like connected and like join together and like help each other out from different regions, China and Southeast Asia, and like that.
Excellent. Thanks so much.
Great. Thanks so much, Kevin. Great job. All right. Well, that concludes our student presentations today. So I just want to give them a round of applause. I think everyone did a spectacular job. I will be taking the judges with me into a separate breakout room. We're going to be deliberating. Those of you who are going to be staying in the main room, I leave you in good hands. You will be with James Fletcher and Brian Jack. They're going to be doing a little bit of Q&A with you guys, and we should return shortly. So have a great time, and we will be back.
Thanks, Christine. And thanks, everyone. Judges, good luck. This is very, very difficult. Look forward to hearing the results. And young investors, I just want to take a minute and congratulate you. What an amazing year that we've had in Young Investor Society. It's been ups and downs and challenges, but for all 6 teams to present that caliber is just unbelievable. Really, really impressive. We have a number of questions that we received from different students. So Brian Jack, actually, I'll turn the time over to Brian to introduce himself. And then we'll give a brief intro, and then we have a couple questions prepared from students, but feel free in the chat if you would like Brian or I to answer any questions on the markets or on career or college prep. We will be happy to. So Brian, do you want to introduce yourself?
Sure. Good evening, everybody. I just want to echo what James said. Those were some fantastic presentations. It's really fun to see this now in its 5th or 6th year. Every year, the presentations, the analysis, they continue to get better and just make it harder for the judges. So we love to see that, especially since I'm not a judge this year. That's even better. So yeah, my name is Brian Jack. I'm based out of Utah. I am the Chief Financial Officer of a community bank here that's just over $1 billion. And we are a division of a public company, Glacier Bancorp, which is approaching $22 or $23 billion. So that's kind of my background. Like James said, we did receive some questions. And if you have any questions, feel free to drop them in the chat and we will answer them. So James, did you want to take the first one?
Yeah, why don't we start? So we received this question. Where would you say are some upcoming hotbeds for innovation and entrepreneurship, both in the countries or the fields? So that's a great question. I think a lot of you touched on a lot of the growth in secular trends that we're seeing. So, a couple that come to my mind that we're looking at our portfolio is the shift from offline to online, digitalization. So that includes everything on the digitalization sphere of semiconductors and upstream, all the way to data centers as well. Healthy eating and brands. So brands are still strong business models, just like we learned about Johnson & Johnson today, but companies that are able to make that shift into health trends. Fintech. So we talked about PayPal today, but fintech is definitely a trend that we like. I like, as many of you know, I like network effect businesses. So I like platform businesses that create a network effect. PayPal, Garena, we talked about some of them today, but when you have businesses that can create that platform value and have incremental returns on capital be higher and be low cost, able to grow because you've created that dominant network effect, we are attracted to those businesses, and you find them in social networks, you find them in classifieds, you find them in search. And one of the things that we love to do as investors is to find winning business models, maybe in the US, and then go find those business models overseas. So, Sea Limited is a great example of finding business models that work, that are proven, and then go find those leaders in other countries. And what makes a company strong in one market is a lot of the factors that will make a company strong and a long-term winner in another market. The last, I guess, word of caution I would give on this question is, Warren Buffett a couple weekends ago in the Berkshire Hathaway AGM, he put a couple interesting charts. First, he put the largest companies in the world 30 years ago. And then he put the largest 30 companies in the world today. And you look at the two charts and there was no overlap. 30 years ago, there was a lot of Japanese companies on the list. Today, there's a lot more Chinese companies on the list. But it was astonishing to see that no company that was the largest 30 years ago is the largest today. And, you know, we were looking at the numbers in emerging markets and in the US, and over any 10-year time horizon, when you take the largest companies, there's about a 20%, 10 to 20% chance that that company will be able to stand the test of time and outperform over the next 10 years. So basically, it's a word of caution that you can pick the right sectors and you can pick the right industries, but it's still very difficult to predict that long-term winner. So stay vigilant. And the other thing Buffett talked about is the auto industry and the hundreds of companies, auto companies, that all started with the letter M as just, you know, a random choice. So even if you picked auto industry as a winning industry, it's still difficult to pick the long-term winner, which is why as investors, we need to stay vigilant to those trends. Brian, did you have anything to add?
Yeah, just to go off that a little bit, I really like how James mentioned that turnover in top companies and cap. It's really important to always reevaluate both what assets are in the investment portfolio, as well as specifically what those investments are. You know, whether it be through diversification or, you know, are we making sure and keeping up with those things that we're already invested in to make sure that viability is still able to continue. A couple different sectors that I thought are going to be really, really interesting to see how they could potentially change the landscape. First is blockchain technology. We've seen it a lot with cryptocurrencies, but the blockchain technology can really be used in a lot of different fields, whether that's financial, within the healthcare field. It'll be really interesting to see how that's going to be used and how different companies can leverage that, both to connect and engage their customers. Another thing would be the healthcare. I think we're at the opportunity or at the point where technology is getting to the point where it can truly have an inflection point on healthcare. You know, whether it be through, you know, the invention and improvement of nanobots, where you know, that technology's been enabled to go and find cancerous cells and destroy cancer on that type of a level, as opposed to through the traditional means that are used now. Recently, I was reading an article about 4D printing. I never heard that term until a couple weeks ago. And for those of you who don't know it, it's a 3D print, but the fourth dimension is when there's a change to its environment, that 3D object changes or adapts. And one example that I liked was, or applicable way that it could be used is, think of a stent. You know, somebody who has one of their arteries or veins clogged. Just think about, instead of, you know, having to go in through the veins and dig around the body and find out where that clot is, just a simple shot with one of these 4D stents, have it circulate through the body automatically, and when it measures that, it pops out, you know, and does its job with very minimal evasive. So I think healthcare has a great opportunity to see some interesting things happen in the future. But like James said, it's always important for us to keep our timeline horizons and to remain vigilant about what we're looking at and investing in.
Great, thank you, Brian. We've received a couple questions from students to me directly, but if you have more questions, feel free. We'll answer the next one, which we received multiple times, which is a variation of, what are your thoughts on Bitcoin? What are your thoughts on cryptocurrencies? What does this mean for the future? So I would answer this by saying, first, I'm not an expert, and many of you may be more experts in using Bitcoin and the values of cryptocurrency than I am. What I would recommend as a long-term investor, what we've seen over the years is new products and hedges and weighing optionalities have a place in a portfolio, but you need to be very smart about how much money or how much percentage you would put in the portfolio. So if it was me, I would put anywhere between maybe 3 to 5% of your assets, your investment portfolio in cryptocurrency. Kind of treat it like how investors have treated gold for years, as this is an inflation hedge. This is a hedge based on if the dynamic of central banks and monetary policy change in the long run. And there's value in a portfolio of having hedges and having non-correlated assets. So I see a lot of value there. I'm not smart enough to say that I think this deserves to be, 50% of your portfolio and that this is the future. And maybe you may have a different view, but I think there is value to having this as a hedge and having this as a optionality of products that very well may become much bigger in the future. Brian, you're the CFO. I don't know if you have any added insight there.
It's really, really interesting. So I hopped into cryptocurrency probably 4 or 5 years ago. I bought some Ripple with the anticipation that Amazon would be using that as an acceptable currency. Bought it at half a penny. And then Amazon came out and they announced, hey, we're going to be using it. It shot up to $2.50, $3. And then the next day, Amazon said, hey, you know what? It's not stable enough. And it dropped right back down. I think there's always a little bit in an investment portfolio. In my opinion, it's more of a speculatory investment, and there's always some room in your investment portfolio for a little bit of speculation, a little bit of fun, right? Investing should be fun. I do agree with James, though. One benefit that it does have is against inflation. Specifically, with me working in banking, monetary policy is extremely important. And as specifically here in the United States, as the national debt continues to increase, that decreases the effectiveness of any quantitative easing or monetary policy that the Fed is able to exert on the economy. Essentially, what that means is it gives them less power to influence the economy and interest and inflation rates as well. So all in all, it's fun. To me, the interesting thing is the technology behind it that I think is going to be able to be leveraged a lot more.
Great. Thank you, Brian. Okay, so we'll take a question that was directed at me from Suma Dendi. And it says, do you prefer value or growth investing? What are some risks and shortcomings with growth investing? Okay, so that's a great question. It's very topical, as I'm sure many of you are aware, that basically the decade from 2000 to 2010, let's say, so that 10 years, value outperformed growth significantly over that period. And then this last decade from 2010 to 2020, growth outperformed value significantly over this period. Over the past year, so 2021, value has outperformed growth. And so this is a key question that a lot of the industry is asking is, okay, what does this mean? Are we starting another 10-year bull market in value? Is this a short-term blip? And so you see a lot of these questions over value versus growth. Now what does value mean? I mean, I think most of you are aware, but value tends to focus on, price to cash flows, price to book. The value sectors tend to be financials, more materials, more asset heavy, more industrials businesses. And then the growth tends to be the more tech, healthcare, and a number of the consumer businesses. So, those are sort of the sectors. What I would say is I hate the definition of value and growth is how I always answer it. So a good stock should have value, should have growth, it should have quality, it should have everything. I would argue that Amazon was a value stock and possibly still is. Why? Because when you look ahead, 3, 4, 5 years, if you were to forecast those cash flows right, you would have actually seen that you were getting a massive bargain on the amount of cash flows that they were going to deliver. So even though, 3, 4 years ago, the PE ratio looked very high on Amazon, but they were growing into a value that they were actually massively undervalued on a cash flow basis. And so, to grow cash flows and to have a sustainable business that's going to be bigger 3, 5, 10 years down the road, it should have growth and it should have value as well, because it should be the combination of everything. So that's how I would answer the question is, ideally, you would have growth and you would have value in all of your investments. Brian, I don't know whether you would add anything to that.
I'm going to ditto that. That was perfect, James.
Okay, great. I know our judges are back and I know everyone is on pins and needles to hear the results. But thank you, young investors, and congratulations on a fantastic year. So I'll turn it over to Christine. Oh, Christine, you're on
James,
mute.
if you can talk for a few more minutes, I'm updating the PowerPoint.
Okay, wonderful. So we were just talking on value versus growth investing. And the debate is kind of a superficial debate in that the best investments in a lot of the stocks that you guys went through today is you had your value component and you had your growth component. You would always want to buy a stock that's at a discount to what you feel the value is over the long run. And that's justified by the quality, it's justified by the growth, it's justified by the ESG considerations. And in the end, it's justified by the value of cash flows that this business is able to deliver over the long run. So I would argue that you would look for value and growth in your investments. We do have time for, I can answer one more question, Christine, or we can turn it over to the results.
All right, you guys, that took a little bit longer than I had anticipated, but we finally have our results for our 2021 Global Stock Pitch Competition. So super excited to share with you all. But first, I want to thank our judges for doing an amazing job tonight with asking questions to each of our teams and being able to work together and come up with the winners tonight. So Greg Shell, thank you so much. Deepika Sharma, James Sun, Jeff Garcia, Kristen Kinnear-Hill, Kevin Carter, Lee Mackey. Thank you guys so much for being here. Thank you for taking the time and watching our student presentations. Without further ado,
Christine, let's present it so you can't see. Yeah.
I was just about to.
Great.
All right. In third place today, we have Elizabeth Jang, who pitched PayPal. Great job, Elizabeth. Elizabeth wins $1,000 in cash, Apple AirPods, and a $500 scholarship from the Investometric Group. Great job, Elizabeth. In second place, I have Jasper Lau from Renaissance College in Hong Kong, who pitched Logitech. Jasper, you win $2,000 in cash, Apple AirPods, and a $500 scholarship from the Investometrics Group. And in first place tonight, the suspense is killing me. Are you ready? Congratulations, Utej Manava and Shabam Shuri from Central Peel Secondary School in Canada. You win our first place. You guys get $3,000 cash, Apple AirPods, and a $500 scholarship from the Investometrics group.
Congratulations. Amazing. Our first winner from Canada.
Yeah, super exciting. I want to leave you guys with some words from our judges. Judges, did you guys have anything before we leave? Jeff?
So impressed. Everybody here is a winner in my book. Us the judges more, because we learned so much from you all. So thanks for giving us a chance to be here. And just keep going. You know, the best thing about investing is you can do it all the time. And you all have such an early start that you're going to be amazing. You know, you keep doing this process, and you know, everybody here is happy to be a resource, I'm sure, me included. So thanks for allowing us in.
Excellent. Kristen, did you have any final words?
Excellent. I'd echo Jeff's comments. This was, you think of investing and all of this, like, oh my gosh, a lot of work. This was so fun. So I just say to all of you, keep having fun with it. When you're passionate about something and you really care about something and you're learning, it's really contagious. So take that advice that I give to you for the rest of your successes, but great job. This was really fun, and keep at it.
Excellent. Kevin?
I think Jeff said it great. You are young, and the miracle of compounding is a very, very, very important thing in investing. And so you are advantaged in the ability to take advantage of the miracle of compounding. And I would also say that the voting was very, very hard, and all of you got #1 votes along the way. So there was all of you were very much appreciated, and you all did a great job.
Excellent. Deepika?
Yeah, I would agree with everything that's been said. Very impressive. Everyone did really, really well. It was very difficult for us to make a decision in the judges' chamber. I think, we kind of laid out our biases the way that we asked you to when we asked you questions, and you guys had very excellent answers and were very good on your feet. So just continue doing that. Don't be disappointed if you didn't win. It's about making it here and doing the presentation, and like everyone said, you're all winners.
Excellent. James, any last words?
Absolutely. Well, this is my first participation. I'm extremely impressed. I want to say everyone, all the 6 teams here, you're all winners for being here, and all did a wonderful job. I expect to see some of you being excellent in the industry, and I will wait for you here.
Very nice. James Fletcher, final words.
I know we're running over. This has been so fun, and I'm so grateful to the judges, to the investors. Can we have Utej and Shivam just say a few words, and then we'll close?
Sure.
Yeah, I just want to say thank you. It was an amazing experience. Coming from the Canadian side of things, a lot of us do want to break into the American market. So it's good to see that there's a lot of strong future prospects, and hopefully one day we can work together.
Same here. Thank you everyone for the opportunity. We don't have many of these opportunities in Ontario, our province. It was nice to see that we were able to participate in this competition. Great learning opportunity for me personally, and I hope to add this to my future, or help this develop my future career.
Excellent. And boys, if you would stay after for a little bit, I have a couple of questions for you.
All right. Well, thanks everyone. And this concludes the 2021 Young Investor Society Stock Pitch Competition. So round of applause for everyone. What a wonderful year. And thank you all for your support.
Thank you.
And thank you, Christine, for managing all of this from start to finish. Amazing. We could not do it without you.
Thanks.